Navigating the investment landscape. Considerations in actively managed versus passively managed real estate funds. In the realm of real estate investment, the choice between actively managed and passively managed funds represents a pivotal decision that can significantly influence an investor's portfolio performance. Understanding the nuances of these two approaches is crucial for making informed investment decisions in the dynamic and diverse world of real estate. Let's explore the key considerations when evaluating actively managed versus passively managed real estate funds. Asterisk the active management advantage. Asterisk. Actively managed real estate funds are characterized by a hands-on approach, where fund managers actively make decisions to buy, sell, and adjust the portfolio composition. This approach hinges on the expertise of fund managers to identify market trends, capitalize on emerging opportunities, and strategically allocate assets. The potential advantages of active management include the ability to outperform the market, generate alpha, and adapt to changing market conditions. Consider a scenario where an actively managed real estate fund leverages the expertise of seasoned professionals to identify undervalued properties in a specific market poised for growth. The fund manager's active involvement allows for nimble decision-making, such as acquiring properties before they experience significant appreciation. This proactive strategy can result in superior returns compared to a passively managed fund that simply mirrors a broader market index. Asterisk the passive path. Asterisk. Conversely, passively managed real estate funds aim to replicate the performance of a specific real estate index or benchmark. These funds typically require less day-to-day involvement from fund managers, resulting in lower management fees compared to their actively managed counterparts. The appeal of passively managed funds lies in their simplicity, cost-effectiveness, and the belief that over the long term, markets generally trend upward. For instance, consider an investor seeking broad exposure to the real estate market without the desire to cherry-pick individual properties. By investing in a passively managed real estate fund that tracks a widely recognized real estate index, the investor gains diversified exposure to the market without the need for constant monitoring or active decision-making. This approach aligns with the set it and forget it philosophy, making it an attractive option for investors with a more hands-off approach. Risk and return profiles. Asterisk. One of the critical considerations when choosing between active and passive real estate funds is the risk and return profile associated with each approach. Actively managed funds, with their dynamic strategies and potential for outperformance, often come with higher management fees. Investors must weigh the prospect of enhanced returns against the increased cost of active management and the inherent risks associated with relying on fund managers' expertise. Passively managed funds, on the other hand, tend to offer lower fees due to their more straightforward approach. However, investors in passively managed real estate funds may miss out on the potential for alpha generated by astute fund managers. The risk-return trade-off becomes a pivotal factor, with investors needing to assess their risk tolerance, investment goals, and willingness to pay higher fees for the potential benefits of active management. Market conditions and investment horizon. Asterisk. The performance of real estate funds is deeply intertwined with market conditions, and the choice between active and passive management can be influenced by the prevailing economic environment. During periods of economic stability and predictable market trends, passive management may be a viable option. However, in dynamic markets with evolving opportunities and challenges, active management can provide a strategic advantage. Consider a scenario where a real estate market experiences rapid shifts due to demographic changes, technological advancements, or regulatory developments. An actively managed fund, with its ability to respond to changing conditions, may be better positioned to navigate these challenges and capitalize on emerging opportunities. Investors with a long-term investment horizon may find active management appealing, as the flexibility to adapt to evolving market dynamics becomes increasingly valuable over time. Diversification and asset allocation, asterisk. Diversification is a cornerstone of sound investment strategy, and the choice between active and passive real estate funds can impact a portfolio's diversification profile. Actively managed funds may focus on specific sectors, geographies, or property types, offering targeted exposure that aligns with a particular investment thesis. Passive funds, by nature of tracking broader indices, provide more generalized exposure to the overall real estate market. Investors must consider how each approach fits into their broader asset allocation strategy. Actively managed funds, with their potential for specialization, can complement a diversified portfolio by providing exposure to unique opportunities. Passively managed funds, meanwhile, contribute to overall diversification and may serve as a stabilizing force during periods of market volatility. Conclusion. Asterisk. In the intricate landscape of real estate investment, the decision between actively managed and passively managed funds is a nuanced choice that demands careful consideration. The dynamic nature of real estate markets, coupled with the diverse risk and return profiles associated with each approach, underscores the importance of aligning investment decisions with individual goals, risk tolerance, and market conditions. Whether opting for the strategic acumen of active management or the simplicity of passive investing, investors must navigate the complexities of real estate with a keen awareness of the factors that shape their investment landscape. By doing so, they can construct portfolios that stand resilient in the face of market fluctuations and contribute to long-term financial success.